In this video, we're going to discuss work in process inventory. So you would see work in process inventory for a manufacturing company. And if you remember, manufacturing companies have three types of inventory. They've got raw materials inventory, then they've got work in process, and they have finished goods. So I just want to focus here on the work in process. So what work in process is when the company has acquired some raw materials and then they actually move those raw materials into production and they begin working on the raw materials and they're applying some labor, they're doing some other things. They're actually working on building the product, but the product is not finished. It's a partially built product. So if you think, for example, of a house, if you've ever seen a house that is under construction, it's still in production, it's not ready for anyone to live in it yet, maybe they've got the frame up and so forth, but the house isn't completed, that would be an example of work in process inventory for the company that's building the home, right? And so ultimately, when things are finished, then they're going to be shifted into finished goods inventory. But I want to focus here again on work in process inventory, which is sometimes just called WIP. You'll see WIP, WIP inventory. And I want to show you the journal entries that would take place to record WIP and so forth. Okay, so let's say that your company builds canoes. Okay, so you're going to build you build canoes, you like the outdoors, and you've got $88,000 of direct materials and $2,000 of indirect materials that are put into production. Now here I'm not talking about buying raw materials. You already have the raw materials on hand. The key is you're taking them and putting them into production. And so when you put materials into production, now it becomes work in process inventory. Okay, so if we're talking about like building the canoes and you just bought some wood and you had the wood just sitting there and you weren't actually doing anything to it, that would be raw materials inventory. Okay, so what we're doing here is we're taking it out of raw materials, and so that's we're going to credit raw materials inventory for $90,000. And then we're going to have some debits. We're going to debit work in process inventory for $88,000, which might seem confusing to you. You might be thinking, hey, we're taking $90,000 out of raw materials inventory. Why isn't it a debit a work in process inventory of $90,000? The reason is we debit WIP for the 88 because that's the amount of direct materials, but the indirect materials are actually manufacturing overhead. So this is the actual manufacturing overhead. And so we debit manufacturing overhead. This is going to be called what's called a clearing account. And we're going to keep track of our actual manufacturing overhead because later we're going to compare it to the applied amount of manufacturing overhead. That's the estimated amount. We actually make an estimate at the beginning of the period of what manufacturing overhead will be. So here we're tracking the actual amount and we'll later compare that to the estimated amount. We'll have to make an adjustment and we'll talk about all that in future videos, under and over applied overhead. But for right now, let's just focus on what's happening with WIP. So now the employees in the factory do some work, right? So now we have, let's say, $30,000 of direct labor. Remember, direct labor is touch labor. That's the people actually assembling the canoes. They're doing physical work to build the product, and it's clearly traceable to the product. And then we have some indirect labor, $10,000 of indirect labor. That's maybe a janitor who's sweeping the floor in our factory. Okay, so now what we're going to do is let's say we pay cash to these people, so we credit cash for $40,000, but it could also be credit wages payable if we don't pay them immediately. We're going to debit work in process inventory for $30,000. That's the direct labor. But then indirect labor is manufacturing overhead. So we're going to debit manufacturing overhead for $10,000. Now you might be wondering, hey Michael, at what point are we actually going to move this $10,000 into the work in process inventory? Isn't that part of it and so forth? How is this ever going to flow through cost of goods sold ultimately if we keep debiting manufacturing overhead? Don't worry, we will deal with that clearing account. Okay, now let's say it's we get to a point, let's say the company's using job order costing or something and they just finished a job, or we'll get into all that later, but at some point they apply the estimated amount of manufacturing overhead. Okay, and so let's say they apply $15,000 of manufacturing overhead. When that happens, then we are going to credit the manufacturing overhead account to reduce it, and we're going to debit work in process inventory. Okay, we're going to debit work in process inventory. So the amount that goes to WIP inventory is actually the amount that we applied from. Okay, so and we'll get it. Don't worry if you don't understand the idea of applying manufacturing overhead. We'll talk about that in future videos. Now, final part. At some point, we complete some of the inventory, right? And eventually we'll complete all of it. But let's just say for right now, we finished up $20,000 worth of inventory. So what we need to do is, remember, we originally started, we got rid of the raw materials, okay, and then we said, okay, now we've got some WIP, some work in process. But now it's no longer in process, it is finished goods, right? It's ready for sale. So what we're going to do, and this isn't all, I'm just saying some of the inventory, not everything above just some of the inventory here has been completed, $20,000 worth. So we're going to debit finished goods inventory, which is going to increase it, right? It's an inventory, it's an asset account, so it increases with a debit. And then we're going to credit work in process inventory for $20,000. Okay, again, I just came out of this number 20,000 out of thin air. So don't wonder if, like, hey, did he calculate that or what? I just picked a random number. The idea here is, when we at some point finish the materials, we need to transition and say, okay, let's reduce our work in process inventory and then increase the finished goods inventory. Then ultimately later, and we'll get to this, when we actually sell the inventory, then we would be crediting finished goods inventory and debiting cost of goods sold. And that would be the point where the actual costs flow through the income statement through cost of goods sold.